Yeah, it's the question everyone's asking, and as you pointed out, all eyes are on the Fed and on Powell right now. But look, if there's any indication in his language about a pivot or even a potential pivot to reducing the pace of hikes, you'll see a rally, and that's what the market's looking for. I think it's a lot of wishful thinking, and it's surely this rebound in October was based on that particular hope. So there's not a lot of data to indicate that he's going to do that, though. So, look, maybe he might indicate with some language that's dovish, but I just don't see it, with the PCE coming out last week at 0.3 and 0.5 on the core. I just don't see that kind of data, allowing Jerome Powell to change his language or his tone that we've seen the last 2 or 3 months.
Greg, it's interesting because if we were to see a dovish pivot, whatever that pivot looks like, something as soft as signaling that rates won't be hiked as aggressively or something much firmer than that, the trouble is that if we are to hear a dovish shift from Jerome Powell, it would mean that he is so concerned potentially about things he's seeing in the economy. I mean, yes, it could mean that he thinks inflation is starting to get under control. But on the other hand, it would just be confirmation that the fundamentals are weakening. So is that necessarily a positive for markets?
I don't think so. I mean, look, there is some real headwinds ahead on the economy. So he might see that, but it takes a while for these interest rates to work. And you're still hovering around 3% on the short end and 4% on 10 years. That's probably not high enough, especially that they haven't, the fiscal policy hasn't really addressed the supply side issues. So without liberating the supply side like we saw in the 80s, you're probably depending on the Fed hiking rates, and a recession might be the only thing that will work here. So, you're starting to see some cracks in the economy. Credit card debt has accelerated. You're starting to see earnings come down a bit by many measures. So, but it's not a recession yet. And I think the end of speculation, in my view, on a change in his tone was the 11.7 million job openings that were announced. And so that's something where he knows he has room in the employment, in the employment measures to raise rates even more. So I think he will proceed with that. And that seems to be the tone from him the last few months, while the market's looking for good news and really rallying on any hint of good news or lack of bad news. I'm not sure that's a way to sustain a rally.
Yeah, very interesting. I guess some of the valuations are looking a little bit interesting, Greg. Look, in terms of real assets, and that's where you want to put your money, and you would say to our viewers, if you can get access to private markets, real assets such as infrastructure and natural gas, such as agri-businesses, such as food security, the old adage comes back to me that the cure for high prices is high prices. So my worry is something that we've seen many times cyclically, Greg, and you will know about this as well, is that actually you see a wealth of money into those areas that you quite like there, or that many people think are going to be longer-term thematic plays. And the problem is, because so many people have invested, they become less valuable. Concern about that at this stage of the cycle?
Yeah, definitely, especially in the liquid markets where you've seen some money chasing too few assets, and deals are getting harder to come by. That's why I think you have to look at alternative markets as well as alternative sectors. And you pointed out agri and infra. I think there's a lot of opportunity in energy given what's happened over the last 12 months with energy prices. So, but there are still opportunities. We like emerging markets, especially Africa, where you don't really see asset inflation and prices are still very moderate. So, and as long as you're in assets, that are inflation adjusted in terms of the returns, you can look for non-correlated returns that adjust with inflation. It's really more of a yield play rather than a growth play. And I think that's the place to be right now, especially, with the aversion to long duration assets that are trading poorly because of higher interest rates. If you could get yield that's adjusted for, either based on commodity prices or is adjusted for inflation, which most of these real asset returns are, I think it's a smart place to be.